All right, we've got everybody here today. Welcome. Wow, another full house. It's great to see everybody here, and thanks again to all our clients. And we've also got a number of guests here today as well too. It's just wonderful to have a full house to come along to one of our client events. We're getting towards the end of the year and everybody's busy, but it's great to see you making time to come and attend these functions. All right, just a few things we want to go through, and then we'll get to the main part of the day. I think most of you know me. My name's James. I'm one of 6 advisors at the firm. So there's Paul, obviously Patrick, there's Sam, Amelia, who you all pretty much know, and also we've got Adam, who's just recently come on board with us. So I'm sure Adam will get around to meet you all, but he's a relatively new employee and one of our advisors here. We've also got a whole bunch of other staff here as well too, who've made the time to come today. Karen, Christy, Oren, and in no particular order, Rebecca, Ethan, Melanie, Widdy, Leanne, and May, of course, because nothing really happens without May's input. There are only a few slides today, which is great, okay? So this is a Q&A session, what we've done them in the last couple of years, and we find that our clients really enjoyed them. So to Q&A, Paul and Patrick will ask the questions, and we've got some of the leading investment managers in the country to talk today to us and give us their views. And what we hope to do is finish around about 1:45 and leave about 10-15 minutes to take questions from the floor. So I ask that if you do have questions to ask any one of these 3 gentlemen, please leave it to the end. We will do a formal question from the floor. There's notepads and pens on the table, so feel free to write or jot anything down. You've also got the presentations, I think, as well too. And we also ask that you fill in the online feedback form, please. Post the session. May will send it out via email. If you can all turn off or put your mobile phones on silent, please. Yep. The bathrooms are back near the front door. So we aim to finish at 2, but have about 15 minutes of question time at the very end. So today's session, we're very fortunate again. The Q&A panel that we run is very, very popular. We've got Nick Griffin from Munro. He'll give us a view around where international markets are and some of the factors affecting that part of the investment markets. Then we've got David Grace from Australian Foundation Investment Company, or AFIC, and he'll give us a bit of a rundown about the Australian part of the market. And then finally we've got Tim Hall from Fairview, and he'll give us a really unique look around the small cap stocks. So we always like to include small caps in our clients' portfolios. We think there's some wonderful companies in there, and it's great to hear from Tim to see what his views around that part of the market's like. From my point of view, as I said, I'll pass it on to Paul first, but if we can just put the disclaimer on, Paul. Okay, all right, so there's the disclaimer, as usual. Legalese. If you've got any questions, ask us later, okay? That's all. All right, I'll hand over to Paul. Thanks, Paul.
Welcome everybody. Can everybody hear me okay? Great. It's wonderful to have everybody here on a Monday afternoon, quite a dreary Monday afternoon, to listen to investment markets. Now, just one important public announcement. If you're a Brisbane Lions supporter, or if you've been audacious enough to wear a Brisbane Lions scarf here, security will be here shortly to escort you from the room. That's actually mean. That's really... No. We'll get serious here. So welcome everybody. It is great to have everybody along. As James said, we are incredibly fortunate to have access to some of the finest investment minds in Australia. We're in a very privileged position that we get to hear at the coalface as to what these guys are thinking. So what we've decided to do is we're going to let them each do a quick 3 to 5 minute introduction of themselves and of the investment or investments they manage, and then Patrick and I are going to fire away with questions, and we're going to leave a little bit of time at the end for questions from the floor. So we think, as always, you guys will really enjoy this. I'll hand over to Nick, who will go first.
Yeah, thank you very much for having me, and thank you, Paul. So use that one, not working as well? Okay, so my name's Nick Griffin. I'm the CIO and one of the founders of Munro Partners. Munro Partners is based here in Melbourne, Australia, and our job is to be your global growth investor. So that's global equities, so we do everything outside of Australia. Don't ask me any questions on Australia. I don't look that closely. But we do all your investments outside of Australia, and we're mainly growth investments. So when we say growth, that means we're generally sort of glass half full. We like to think about what's possible, not what's impossible. And our job is to take your money and invest it in, roughly between 20 and 40 of what we think are some of the best growth businesses in the world. That's me. We have 4 products. You guys, I believe, are invested in 2 of them. We have the Munro Global Growth Fund, which is actually quoted on the ASX under the code MAET, or MATE, as we like to call it. We tried to get MATE, but the ASX would not give it to us. We have the long-only version of the same thing. So you're in the absolute return version, which is the version with downside protection. So things like put options, etc. If something in geopolitics goes wrong, I'm sure we're going to talk about that today. We also have the Munro Climate Leaders Fund, which is a satellite strategy that invests in the enablers of decarbonisation. It's a very good performing fund at the moment because this is a very topical area, which I'm sure we'll talk about. And we have a small cap fund. That's forward, yes. Okay, just really simply, one thing you should know about us, I'm not going to go into huge detail here, but I just make a simple observation, and maybe this will help you with your own investing. There's 2 types of companies in the world. There's the one on the right there, or the right, which is a cyclical company, that's Bank of America. The black line is the share price, and the grey line is its blended forward earnings per share. Okay, and on the left, you have a structurally growing company, which is MasterCard. The black line is the share price, and the grey line is the blended forward earnings per share. And so the simple thing you need to understand about picking stocks is stocks generally follow their earnings, okay? Earnings go up, stock goes up, earnings go down, stock goes down. Cyclical companies are going up or down based on the economy, if that makes sense. What's interest rates, what's happening with retail sales, etc. We're really focused on structurally growing companies. In this case, it's MasterCard. It's obviously benefited from the shift from physical to digital cash. It's been benefiting from that for about a decade. Hence, it's grown structurally, regardless of what happened in the economy. Structurally growth ones are quite hard to find. Cyclical ones are everywhere. And our process as growth investors is just to find structural growth companies over and over again. The second last thing I'd say about this is we actually think this is all that really matters. And I know we're going to get stuck talking about the macro today, and I know we're going to get stuck talking about geopolitics. But the reality is equity market returns are just made up of these few great structurally growing companies. If you took the US stock market over the last 90 years, roughly 25,000 companies listed, the top 50 out of those 25,000 make up nearly half the entire returns created. Half the entire returns created. It's exactly the same in the Australian market. It's exactly the same in global markets. All of them are growing for structural reasons. And so we just plotted the top 50 there. Over the last 50 years, you can see annualised return in time and months. It's always the same. There's always a big structural change. In more recently, that's been tech and digitalisation, so Amazon, Facebook, Google. I'm sure we're going to talk a lot about AI. But if you go back in history, it was the same. It was things like big box retailing with Home Depot and Walmart. You go back a bit further, it was quick service restaurants with McDonald's. You go back a bit further, it was air travel with Boeing. It's always the same. Big structural change, couple of big winners. Our job is to find the structural change and find the winners. Last slide, I won't spend a ton of time on this one, but so what we do is basically just ignore the entire global equity universe and try and just focus on that small structurally growing universe. We think there's 6 great qualities to a great growth company. You should steal these. Took me a very long time to work this out. But they need to be able to grow. Their earnings have to grow faster than their revenue. They need to be able to do it durably for 3 to 5 years. They generally have controlling shareholders, and their customers generally think they're amazing. If you fail one of these tests, you're generally not going to be a great growth company. Apple had them, Nokia didn't, Google had it, Yahoo didn't, Amazon had it, eBay didn't, Macquarie Bank has it, National Australia Bank doesn't. And then the last thing on the right is just how we manage risk. So those are our top 10 winners since inception and top 10 losers. Very important to flag that, if there's only a few winners, you're probably going to invest in a loser. I can assure you, our stats tell us 50% of the time we invest in a loser. That's what we know over 8 years. And that's good because, let's face it, 90% of them lose. So have some sort of process for recognising you've made a mistake and remove it. And that's just what we're showing you on the right. Our top 10 winners outweigh our top 10 losers by 15 to 1. So that's really us. That's what we do. We're growth investors. We're trying to find these few great companies for you. We're trying to find them and hold them for long periods of time. And it's always structural change that creates them. I'll stop there.
Over to David.
Thanks, Nick. So I'm David Grace. I'm the Portfolio Manager for Australian Foundation Investment Company, or AFIC as it's more widely known. So I've been in equity funds management for 17 years. And just a little bit about AFIC. So we're the largest listed investment company. The portfolio at the moment's approximately $10 billion. And we've been around the longest. So we're celebrating our 96th year of existence this year. One of the features of the LIC market is that the shareholders actually own the management business. So there's no external fee leakage. And what that means is we can run a low-cost business. So the total MER, or the management expense ratio, is 0.15%. which means that for every $100 invested, you're paying 15 cents in management fees. So I've got two primary investment objectives. The first is to pay a stable to growing dividend over time, and then the second is to provide attractive total returns over the medium to long term. And one of the nuances of the company structure is that we can actually build a reserve of franking credits to help us meet that first objective. That's the ability to pay stable to growing dividends. So, for example, over the COVID period, we saw the ASX 200 companies reduce their dividends by approximately 30%. So that's the dividends we received from the companies we're invested in saw their dividends cut. As we built a reserve of franking credits, being a company, we were able to maintain our fully franked dividend through that period. So you're effectively building a reserve of franking credits for that rainy day and then building them on the balance sheet to be able to pay out at future periods. And then the last point there is all fund managers trying to deliver attractive returns. The point there for us is we're very much focused on the long term, and similar to Nick's slides earlier, so we know over the long term that share prices follow earnings. So very much we've got a quality focus on the holdings within the portfolio. So have a look here just in terms of how we think about the portfolio. So we're very focused on quality. We know as a long-term investor that every company we own is going to go through multiple business cycles, multiple changes of management, and most likely a couple of changes of strategy. So it's really the underlying assets of each business that we're invested into, and that's where we expect to get a return over the long term. So we're looking for companies with a strong competitive advantage, and that those that are generating cash flow to be able to pay or invest in their businesses while still paying a dividend to us as shareholders. So on the right-hand side, if we split the graph here in two, so on the right we've really got where we get our income from. So it's a stalwart companies that own highly strategic assets. They're not fast-growing companies, but they do generate significant cash, and they're able to pay a growing dividend to us. And then the income down the bottom being the banks and Telstra. And on the left-hand side is really where our growth objective comes from. So all the logos shown on the top left-hand side, they're market leaders within their industry. They've got long opportunity in front of them, and they're continuing to generate significant free cash flow. And then on the bottom layer is the cyclical. So this is where we'll have ownership of resources and energy companies. And if you think about our approach being long term, we're really focused on the large cap companies within energy and resources, as really on a short term basis, miners operating finite assets need to replace those assets, which has been a pretty checkered history in terms of return on capital as they've done so. So with that, I'll hand over to Tim.
Testing. Great. All good. Good afternoon. Thank you. Well, good afternoon. My name's Tim Hall. I've been in the industry north of 25 years, started over in Europe back in the 1990s, analysing European mega cap electronic companies, and have progressively slid down the market size spectrum ever since to find myself analysing Australian small cap companies. Fairview Equity Partners is a Melbourne-based investment management firm that's been around for 16 years. It's primarily owned by the investment team with its partner MLC, who oversees a lot of the non-investment functions. Over that 16-year period, the fund has delivered a return of 11% per annum net of all fees, which is 6% above the benchmark. There is an investment team of 4 members, each are PMs, each are owners of the fund, all have equal say in the portfolio, and all are investors in the fund. We do have a single fund focus at Fairview, so all of our time is exerted on the small cap sector. We do have, we're style agnostic, which means that we invest in both growth as well as core, and we invest in approximately 55 to 60 companies within the ASX. We do blend both structural growth winners as well as some cyclical companies. But the defining attribute of the companies that we invest in is that they are catalyst rich. So there's a reason for them, for their share price, for their valuation to move over time. As you can see on the page, which is a snapshot of our portfolio at the end of August, some of these names you would be familiar with, some of them you wouldn't. We can hold some of those winners as they migrate up into the next level of the ASX universe, which is the mid-caps. And one company in there, REA Group, or realestate.com.au, that you'd be familiar with. I remember that, 80 cents. It's now a $200 stock. And Pro Medicus is another one, and that's a radiology software business that is Australian, but has incredibly and successfully penetrated the US market, and that share price has grown from $5 to nearly $200. So that's Fairview in a snapshot.
Thank you, Tim. My microphone works as well, which is good. So just to echo Paul and James's sentiments, thanks to each of the three guys for joining us today. I think most of us in the room are Victorians. It hasn't been a very good 10 days for Victorians. We had a grand final with 2 interstate teams in it. Other than Rob, I think most of it is pretty upset with that. Obviously, the Storm got rolled last night as well, which wasn't good. But what I can tell you is each of the portfolio managers here are Melbourne-based, which is just amazing. So we've got 3 gentlemen here that manage collectively in excess of $15 billion. And as Paul mentioned before, not everyone gets access to that. So thank you to everyone for coming along today. As everyone knows, we're really big fans of rock, paper, scissors in the office, and we got the boys to sort of rock, paper, scissors off at the start. So what happened is the international team won, and they've sent the domestic team in. So Nick is our rock, paper, scissors champion, and he decided to let the domestic guys bat first. And we're going to start with a really, really easy question, guys, to David and Tim. Just your current views on interest rates, inflation, business conditions and consumer confidence. A nice easy layup to begin with.
No, thanks for the question, Patrick. So I guess it's a pretty tricky time at the moment in terms of operating conditions for a number of companies. So if you just think over the last couple of years, we've come out of the COVID period, there's been a lot of stimulus that's gone into the hands of the consumer, and it's meant that sales growth has been pretty strong for a lot of companies, and they've been able to offset cost inflation by putting through price rises. What we really see now, and we've started to see over the last probably 6 to 9 months, is that's becoming more challenging. So really much harder for companies now to be able to pull the price lever. Cost inflation feels that it's stubborn, it's not grown at the same rate, but it's not going away. And under that scenario, then it looks like earnings growth is going to be harder to come by for a number of companies. So our view on that is that we'd expect earnings growth to slow from here, and good companies will still be able to deliver meaningful earnings growth, but it's not going to be as widespread as it was when the stimulus efforts were widespread.
Your views, Tim?
Thank you. At Fairview, we use a bottom-up stock picking approach, which basically means that we don't take top-down macro views. We use our observation of those macroeconomic conditions to try and understand what the fortunes of and future direction of company earnings profiles might be. But domestically, we've seen a per capita recession. In aggregate, that has been avoided really by compressing 4 years of immigration into 2 years, as well as unprecedented fiscal spending. As David said, the consumer has been bifurcated. We have seen the household savings ratio jump from 6% pre-COVID to mid-20s during COVID, and now it's back to zero. But that bifurcation was made evident in the CBA annual result recently, where we saw the under 35-year-olds basically have a decline in spending over the last quarter, and the 55-year-olds spending growth, discretionary spending growth, is running at about 5%. If you look at the small caps at the moment, the earnings growth expectations are greater than the ASX 100 at about mid-single digit. So really from here it feels as if businesses the economy, and consumers really do need that circuit breaker, which will be the first rate cut.
I hope everybody can hear me now. Yes, they can. So, Nick, over to you. I'm not sure you can give a quick answer to this question, but obviously economic conditions overseas, and particularly the US, tend to dominate the financial press. So very keen to hear from you about how you're viewing the global economy at the moment, perhaps with a focus on the US. And I guess a second part to that question is, when you're making decisions about structuring your portfolio and companies you invest in, how much of an impact does that macro view have on your decision-making processes?
Yeah, okay, thank you. So, look, I was just in the US last month, and we saw, 50 companies, and the economy is okay over there. What's really interesting about this cycle is you've hiked interest rates from 0 to 5%, like very quickly. And anybody in this room would remember things like 94 or other times that happened. You generally end up with a recession. But this time that has not happened. You may have had a per capita recession. There's definitely people who are suffering. But the overall economy is okay. And the overall economy is going to pull through this, in our opinion. And so what that means is you're now in this wonderful situation where central banks have managed to normalise interest rates. They got them from 0 to 5. Without blowing up some bank or some, faraway European country, or some, major financial institutions gone under. And the economy's okay. So you've sort of got 500 basis points up your sleeve to now slowly cut rates, if that makes sense. And so it's important to remember that equity markets look forward. If you look forward, it looks quite good because the central bank can cut rates. The economy is not difficult. There's no endemic problems here. You should see a recovering of growth over the next 3 to 5 years. And if I'm a central banker right now, if you can't manage a long and sustained upswing from here, you're quite frankly not very good at your job because you just have so much interest rates up your sleeve. So that's our global outlook very briefly. There's things like the election and geopolitics that you have to worry about. I'm sure that'll come up. But generally, if you landed from Mars, this looks pretty good on any sort of medium-term view. In terms of picking stocks, as I said, we definitely are more bottom-up, so we think more about the structural thing. The thing that a lot of people miss in the US, and I'll just touch on this briefly, is the US is the S&P 500, okay? So the equity market's not the economy, okay? It's so far away from the economy now, it's not funny. The S&P 500 are the best 500 companies on the planet today. In the same way the ASX 200 is the best 200 companies in Australia. So people obviously try to put the economy onto the equity market, and to a certain extent that's true, but less and less so it is today. And most of the biggest companies in the US are growing their earnings not just 5%, they're growing them 15, 20% per annum. Microsoft's a $3 trillion company. Its earnings are going up 18% per annum. And I think they'll accelerate from that. Google's a $2 trillion company. Its earnings are growing at 15% per annum. Facebook's are growing at 20% per annum. Amazon's are growing at 30% per annum. So it's very hard for the market to go down with that strong earnings growth, particularly amongst the biggest companies. So we are quite positive, and I just encourage people to think about that dynamic that the equity market's not really the economy, so don't get so hung up on that. Just look at the earnings growth of these companies, and they're in a very, very strong position today.
So we'll get the geopolitical and political questions out of the way, Nick. So it's a bit going on in the Middle East at the moment. There's obviously an election coming up in the US very shortly. Have you made any changes to the portfolio in terms of the way it's constructed, or you're avoiding any areas with respect to those geopolitical and political tensions?
Yeah, so look, we have held some Israeli companies where we've had to move to the sidelines on those, but that's only at the edges. In terms of the election, look, from our point of view, we'd just be very happy if it was split in some way. Democracy, we're all very lucky. We're all colonised by the British. So we have an upper and lower house. They have a checks and balance political systems. The Americans have it as well. So then whoever gets the presidency is sort of not that big a deal, provided there's a split below them. The only thing you'd have to worry about is if they got all three. And then you might have to change your view on certain things, like if it was the Democrats, you'd have to go more clean energy, for instance, and if it was the Republicans, you'd go more towards smaller caps, domestic topics. So those are the only things at the margin that we would have changed. The last thing we just say is, look, all of our bets are big structural bets over medium-term time horizon. And when geopolitics and things come along, as you know, we run absolute return funds. We are prepared to spend a bit more on insurance at the moment. So we own put options on the fund, we own put options on the market, we own put options on the NASDAQ, and we're prepared to spend a bit more between now and Christmas. Because, yes, geopolitics is volatile and more volatile than normal at the moment. And secondly, the election only comes along once every 4 years. So let's take a bit of that insurance budget we have and spend a bit more of it right now, and that's what we're doing.
David and Tim, have you made any changes to the portfolio? I know it's domestic based, but in the context of what Nick's talking about?
Oh, not so much in terms of geopolitics for us. So really for us, we're bottom up as well, but we're really long term. So we just use events that we're seeing at the moment just to see where there's mispriced opportunities and make sure we're capturing them. And a lot of these events end up being short term and they'll be unrelated to the earnings growth of a company. And where we see sold off on some of the fears associated with this, and we use an opportunity just to add to our holdings.
The one thing about geopolitics that has really surprised us is just how resilient the equity markets seem to be to them, and just the frequency of them and just the sheer number of them. For small cap investing, trading liquidity is the nemesis for small cap investors. So at Fairview, we place great credence on that and ensure that we've got a portfolio that if we do need to respond to any major events, we can when we want to and not when it's dictated by some of these major machinations. Just in terms of sector bets, we don't take dramatic sector bets. Resources, by way of example, is currently at benchmark weight. We have seen recently China come out and stimulate their economy, but one of the offsetting factors to that is that we're not out of the woods, according to some about the US economy, that maybe there is a chance of a hard landing if fiscal spending and some of their machinations are a bit awry. But just also too, at times there are benefits of geopolitical events. And one company that was on the portfolio slide before is an Adelaide-based intellectual property company called Codan. And Codan provides mission-critical communication as well as metal detection, and in this case, countermine. So whilst it isn't the cornerstone of our investment thesis, it has been a beneficiary of the unfortunate Ukraine conflict.
If I could just go off script a little, because you did raise China, Tim. So David, I'm interested to get your views, and then Nick, I will. So we've seen significant stimulus out of China last week by the authorities. So from your perspective, China being a little bit closer to home and an important partner or trading partner of Australia, has this, when something like this occurs, what's your line of thinking as the manager of AFIC?
Yeah, sure. Thanks, Paul. So in terms of the way we can get exposure to China, it's largely through resource companies, obviously. On the consumer side, there's a handful of companies like A2 Milk and Treasury Wine, but it's really through the resources where the vast majority of ASX listed capital can go. If we think about the measures put in place so far over the past couple of weeks, it appears from us that they're really endeavouring to stabilise the property market, which has been falling now for the best part of 3 years, and to provide a layer of confidence for the consumer to be able to switch the economic growth from fixed asset investment to more consumer facing. In terms of what that means for resource companies, so nothing that we can see from the stimulus measures so far have led to future steel demand or an increase in steel demand, so they're not trying to provide stimulus for additional property development or to build more highways, roads, bridges, railways, etc., where steel intensity is at its peak. And so the way that we think about it, if you look at the last 5 years, just simply the iron ore price has averaged $120 a tonne, and we know going forward that there's more supply coming into the market, and with commodities it's always the marginal tonne that actually sets the price. There's a large development in Simandou that Rio Tinto does have a partial ownership stake in that's coming on the back end of next year, so that will add about 6 to 7% to global seaborne supply, and Mineral Resources with their Onslow projects adding about 3 or 4%. So all up, where we're very close to peak steel demand in China and supply coming on board, we think if the last 5 years has averaged $120, we're going to be something less than that going forward, and the current iron ore price is around $110. So we think from here The equities, so BHP, Rio, Fortescue particularly, have rebounded on the back of stimulus measures, but we don't expect them to go on with it much from here. However, we do own BHP and Rio in the portfolio, as we showed on one of the slides. And our thinking there is that as iron ore starts to tail off, you'll start to see the other commodities pick up the earnings growth for them. So copper particularly for BHP, and for Rio it is copper, but also on the aluminium side, where they're going to be low-cost producers, and even at low points in the commodity cycle, they'll still generate meaningful cash flow for us.
And Nick, zooming out a little bit, as a global manager, of course, you can invest in Chinese companies. You've expressed some views on investing in Chinese companies. If you could share with the audience your current views on investing in China and whether you're appealed to buying Chinese companies?
Had to come this week, just after they went up a lot. So we took all our money out of China in 2021 and have been very vocal about not going back there for the last 3 years. And for the last 3 years, that's been roughly the right thing to do until a week ago. I don't see anything that happened in the last week that's going to change that view. To be honest, we don't like the way the country's run, quite frankly. We don't like the fact that the companies we invest in don't seem to have control over their own destiny, because it's run by the government comes over the top, and the government just came over the top last week. I suspect this will be a fleeting rally, and one that, you know, we could even take advantage of on the short side at some point. But from my point of view, what we'd really love to see in China is something that gets the consumer to consume again, to get confident again, or something that changes the leadership situation, or something that allows foreign investment back into the country. And I don't see anything in the last week that changed those three things.
Okay, we'll move to markets, and I'll perhaps start with you, David, and I'll focus on the Australian share market. So I think it's fair to say, and all of our clients and investors know, that it's been a pretty good period to be an investor in the Australian share market. So from an AFIC perspective, or from, let's say, a large cap Australian share perspective, does AFIC have a house view on the valuations of the Australian share market at the moment? And perhaps more specifically, there appears to be some sectors like our banks. You know, when you look at Commonwealth Bank, not today, but at $140, does AFIC have a house view not just on the overall valuation of the Australian share market, but certain sectors within the Australian share market?
Yeah, so look, just at an overall ASX 200 level first. So we've seen the multiple for the market. So if you take any multiple you want to look at, but if we assume, say, price to earnings has rallied pretty aggressively over the last 12 months. So at the moment, the price to earnings for the market as a whole is trading at roughly at a 20% premium to what the 20-year average has been. When you dig into the detail, you can see a couple of sectors have really driven that. So the first is information technology, and the second has been in financials, which, as we know, is largely led by banks. So just over the last 12 months alone, banks are actually up 40%, and it hasn't come from earnings growth, it's just come from the multiple the market's prepared to ascribe to the banks, albeit off a cheap starting point. So we look at that and say it's been very concentrated within two sectors, and that means that there are a lot of losers or sectors that have underperformed the market over the last 12 months. And it's primarily been in the resources sector, which is why you get such a sharp rebound on the back of China's stimulus. Even though the fundamentals haven't changed materially, a lot of fund managers are underweight the sector, and you've seen that come through. And equally now you're starting to see that in energy, which has had a much better run with conflict in the Middle East and what that means for oil prices going forward. So that's sort of where we see the overall market, and we're expecting the drivers of the market to broaden. So feels to us over the last 12 months there's been a bit or a high degree of earnings certainty in information technology and within the banks, and the market's been prepared to pay any price for that earnings certainty. As we get a bit more confidence, whether it comes from interest rate cuts, we start to see the drivers of the market broaden, and we're already starting to see the early signs of that. So just in terms of the banks, we're not expecting rapid earnings growth to come from here. In fact, it's going to be pretty benign. And it's a high starting point of where we are today in terms of the valuations. So going back multi-decades, they're now trading at a PE multiple significantly higher than any time in history. And when you've got low earnings growth and a high starting point, it normally corrects itself by the share price falling. It doesn't have the ability, or the banks don't have the ability, for earnings growth to grow into the earnings multiple that the market is ascribing to them. So for that reason, we've been materially reducing our holdings in the banks over the last few months.
Tim, not quite as easy investing in small caps as large cap global shares and large cap Aussie shares over the last few years. So how do you view the small cap segment of the market at the moment? Obviously, it's had a little bit of a bounce recently, but still, in terms of comparing it to the rest of the market, has lagged.
Yeah, sure. So since the peak in the Small Ordinaries Index 3 years ago, and really the cause for the slide down ever since has been clearly rates and risk appetite. What we've seen over that period of time is the Small Ordinaries Index is down 14%, whereas David's universe is hitting new highs with each day, it seems. So over that period of time, on Australian shores, the Small Ordinaries have underperformed by 30%. In the US, it's about 20%. We did get a reasonable analogue recently of what the market's anticipating with these rate cuts. And back in July, we saw the US small cap market outperform the S&P 500 by 10% in a month. And domestically, we've seen glimpses. So back in Feb and March, we saw outperformance of the smalls, and then more recently, as Patrick alluded to, in September. If you look at valuation, the small caps, I haven't gone quite as far back as David did to 20 years, but if you go back 10 years, the small caps are trading at about a 15% discount. Timing is always tricky, and the question that Patrick asked around when to move back into smalls is a common question amongst asset allocators at the moment. But the one thing that I can say is that when they do rebound, it can be quite dramatic, and there's been a couple of instances in history where the returns have been quite spectacular on a relative basis, and that's been leading into the GFC and out of the GFC. And in both of those occurrences, there was a 60% outperformance.
So back to you, Nick. I seem to be asking you all the questions, don't I? Okay, so I just said to David, obviously the Australian share market's had a pretty good run. Is it harder to find value, or how does AFIC view the market? So from a global perspective, we've had incredibly strong returns from global markets. We've had an incredible return in the S&P. You look at the NASDAQ and now the Magnificent Seven. There has been some significant share price appreciation. So the question, I guess, is twofold. Firstly, how do you see the valuations of the areas that you're investing? And of course, your fund has performed incredibly well. And then secondly, is it harder for you to find value in this environment?
Yeah, so I mean, obviously stocks get ahead of themselves a little bit and valuation can get a little bit high, and it is maybe a little bit ahead of itself right now. But I think you need to take a big step back. And sorry to make this just completely very bullish, but the reality is you are 2 years into what's probably going to be a 5, potentially longer year bull market, okay? In global equities, 2022 was a very difficult year, particularly in growth equities. The NASDAQ fell 33% in 2022. Interest rates went from 0 to 5%. We had an almighty clean-up of the entire market. Our fund tried to manage its way through that with less than a 20% drawdown. Would have liked it to be better than that, but that's what we did. And so we are now in year 2 of this recovery. And so since then, funds put on basically 50% back above its highs, and just put on 30% in just the last year. And our climate fund put on even more than that. But this should be just year 2. You should be year 2 into a 5-year bull market. And the reason why I say that is because rates are still going to come down. Growth is going to get better. You're going to get the broadening out. I've been through a lot of bull and bear markets. What normally happens after a big bear market is everyone runs around trying to find the next big bear market. Well, guess what? The next big bear market's probably 5 or 10 years away. So those would be the main things. The second thing I'd just say is, look, structurally, this is probably one of the more exciting times in my career. We haven't talked about AI yet, but a lot of those returns that I talked about, that 30% plus returns we got in the last year was not just because the market went up. It was because we correctly identified that AI was going to be a big structural shift and that a lot of companies were going to lean into this. They were going to invest heavily in buying semiconductors. They bought a lot of NVIDIA chips. We owned a lot of NVIDIA. It was going to allow Microsoft to create new software platforms. We owned a lot of Microsoft. You were going to need a lot of power to power this stuff. And, we own Constellation Energy, which Microsoft just announced that they're going to reopen nuclear power plants in the back half of this decade just to power all the demand that they have for data centres, and all that demand they have for data centres is because of how excited they are about AI. So what's happening here is you're basically getting an economic recovery, you're getting rates come down, at the same time you're having this huge structural shift, which is AI, and all these companies are leaning into it to invest in it. And it's tempting to say, oh, it looks a bit bubbly, it looks a bit throttly, but it's not. You're at best 18 months into this, okay? So the bubble does not form 18 months off the low, the bubble forms like 5 years off the low. And so everything I learned on the trip when I was over there is like, this is just getting going. This is a very exciting time. Macro sort of goes to the back picture, and our job now is to pick stocks. Right now, a lot of those stocks are around AI and climate themes. And for all of those stocks we're picking, you know, there is years of good news ahead of them, quite frankly, assuming, last big if, and I'll put a big caveat here, assuming we all end up using these wonderful AI products. And I hope some people in the room are already using them. I expect a lot more good ones to go, and don't be afraid to ask me any questions about that.
I love Nick's optimism on a dreary Melbourne day. And I actually think when he was getting real bullish, the sun parted from the clouds. I actually saw it. It's quite good, Nick. You've moved the clouds, but that's incredible. Now, you spoke about a couple of the Magnificent Seven, and this big rally that we've had has been not largely, but substantially attributable to those 7 companies, and you've picked on a couple of those already. Can you talk us through maybe the valuations for a few of those, and maybe the ones that sit in the fund and the ones that don't sit in the fund, because they are the ones everyone wants to hear about?
Yeah, okay, so look, obviously we own NVIDIA, we own Amazon, we own Google, and we own Meta. They're the big ones we own.
All overweight relative to benchmark?
Yeah, they're all, I mean, we don't look at the benchmark that closely, to be honest, but they're all big positions. But it's important to stay, we also own Microsoft. Not one of them trades at much over 30 times earnings today, and that's GAAP earnings. So I know 30 times is a big number, but that's still only about a 50% premium to the market. Yet they grow earnings more than twice as fast as the market. So they're not out of bounds in terms of valuation. I get that that's a little bit full, but they're definitely not out of bounds. The other thing I'd just say is if you think about AI and what AI is going to do, ultimately these companies need to build these large computing clusters to process the massive amounts of compute that we're going to need to get AI to work. Does that make sense? And so when I was over there recently, we met with Tesla, we met with all these companies. Tesla basically doesn't see themselves as a car company. They see themselves as a company that does full service driving and robots and robo-taxis. And so they say, look, our competitive advantage is to invest heavily in compute, okay? Microsoft invests heavily in compute to allow these cloud services to work, to allow Copilot to work. So everyone's investing in these large compute centers. And so what's really interesting is this opportunity just uniquely favours the biggest companies in the world because they're the only ones with the balance sheet to do this. Not many companies in the world can reopen a nuclear power plant, okay? It's going to cost them $20 billion. They're going to build a data centre that's going to cost $50 billion. And the other 4 are all going to do the same thing. So you're looking at hundreds of billions of dollars being invested in this AI technology, and only the biggest companies can participate. And so if it does end up changing the way we live and work, which I think it will, I can't tell you if that happens linearly or bumpily, but I think it will, then these companies are well set up to benefit. And so that's why they're performing. That's why I keep coming back to this point. You know, don't get hung up about the economy. Don't get hung up about the equity markets going ahead because the US market in particular is uniquely driven by these companies and it's all really being driven by their earnings. Multiples have gone up a little bit, but it's mainly being driven by their earnings because their earnings are growing very fast because they're the only ones that can provide these services today and probably into the future.
So David and Tim, I'm going to talk about AI and then maybe bring that back to a domestic discussion. In many ways, it feels like here in Australia, maybe we're behind the 8 ball with AI or we don't have the same advancement or opportunity to invest domestically in the area of AI. And for many people, AI is it's a scary area to be thinking about and the impacts it could have. So I guess it's a twofold question. As investment professionals that are running a portfolio, and speaking with a lot of companies, I imagine a discussion point is AI and whether there's this opportunity for transformative productivity or productivity growth. So I'm interested to hear at a company level what you're observing and seeing here in Australia with AI and the adoption of AI, and then zooming out a little bit, investing via your portfolio, how do you view AI and potentially opportunities here in Australia to get an exposure to that? I'll start with you first, David.
Yeah, thanks, Paul. So in terms of the productivity side of things, I think 6 to 12 months ago, every company when they were reporting their result spoke about AI, and they're a beneficiary of AI as well. And then pretty much every time they did, the stock price went up. So it became a pretty popular theme to actually mention that you were going to benefit from AI. But what we've seen probably in the latest reporting season was that it was far less pronounced. So it was mentioned, but nowhere near as prominent as what it was 6 to 12 months ago. And I think it becomes much harder to work out who are the winners and losers as it relates to productivity. So we think it's absolutely a thing and it's coming. But the cost of that, the likely return on that, who wins and who loses, given we're really playing at the second derivative of AI in this market, becomes a little bit harder. So we're watching that really closely at the moment. In terms of ways you can get exposure to that, it's really through the data centre operators, so NextDC being the largest in that regard. But the establishment of data centres is very capital intensive. The cash flow returns you're going to get from NextDC just kept getting pushed out to the right. They've done 2 capital raisings now in the last 6 to 8 months. And so for us, where we really want to invest in companies that have a fantastic long-term opportunity, we want to be rewarded along the way, they're not going to be paying a dividend anytime soon. So you're really reliant on the long-term share price being higher, and it's already trading at 4 times book, which is 4 times the capital that they've got on the ground. So to us, that looks pretty expensive. But our largest exposure and a beneficiary is really Goodman Group. So they're the ones who are actually developing and building these data centres. They're playing the role of the developer. And what Goodman Group did about 10 years ago was to really clean out their portfolio. So they're an industrial property developer. They benefited from the online trend. They were developing distribution centres, and what they saw quite early on was to move away from distribution centres on the urban fringe and really target sites that are in the inner city and that have a range of alternate uses. And the first of those has been data centres, which we're now seeing them develop quite materially. Being the developer, they develop the site and they earn the cash within the first year of that development. That comes back to shareholders. So we see Goodman Group as being the best way to play it within the domestic market.
And what about you, Tim, at the small cap end of the market? I think this would be fascinating, talking to companies and getting a sense of how they're seeing and feeling about AI.
Thanks, Paul. Yeah, I absolutely mirror some earlier comments. We don't have the same breadth and depth of pure play AI companies that Nick might experience. But I will talk on the revenue side for a moment. So as David mentioned, in terms of data centres, yes, we do have exposure to a data centre operator in the small caps. It's called Macquarie Telecom and doesn't trade anywhere near the same valuation of multiple as NextDC. Beyond that, on the revenue side, there are a number of IT consulting firms. We absolutely had the big bang sort of euphoria moment, but what's evident is that there's a lot of SMEs and smaller sized companies that are still trying to figure out how to best get the productivity and the cost and potentially revenue gains. So we're sort of still muddling our way through. On the cost and productivity side, every company that you speak to is investigating it, and it was a major feature at the Macquarie conference back in May. To talk to a couple of specifics, I think one of the best avenues for AI will be around highly expensive labour, and the radiology sector is perhaps one of those areas. We've seen that through Pro Medicus, a company that I mentioned earlier, and they're really looking to supplement the end market, the hospital's radiologists, with AI to improve their productivity. The other example, just even last week, speaking to a telco company, and they're using AI to take 80,000 calls per week. So it's absolutely a trend, and we do have some exposure, but we're not putting companies solely into the portfolio for AI at the moment.
Is this one of these phone calls where I repeat my name 6 times and my address 9 times on one of those ones? That's why they got the 80,000 calls?
I thought that comment would get a response. I think it's, you're right, I think it's very much sort of steering who's the best resource to then direct the call to.
So as an investor, if you've been lucky enough to identify a thematic, or as you would call it, Nick, an area of interest and invest wisely in that, you've done very well. So whether it's cybersecurity, whether it's AI or whatever it may be, it's a difficult question for each of you, and I will ask each of you, but is there an area of the market, or is there a thematic or an area of interest that excites you, you think is incredibly investable for the decade ahead? So I'll start with you, Nick, and then move to David and Tim.
Can I do two quick ones?
Please, yes.
He always pushes it. He always asks for two. He always does it.
Without talking about AI again, obviously you can understand we're quite bullish on that. Look, the two things we'd talk about are, one, is power. Electricity demand's been flat for a very long time, in some cases nearly 30 years. Electricity demand should, in theory, go up again based off this, and power infrastructure is massively underinvested. So there we're looking at things like nuclear generators, companies that build gas turbines, etc. So that would be one, power in theory, because we have to electrify everything. We're already electrifying everything, and now it gets worse. Second thing I just talked about is public safety. Public safety is an area we've been investing in for a while now. And it is, clear to us that, the world is not as safe a place as it used to be. Inequality is difficult. Social media probably makes it worse. Police are hard. Coming back to your point about trying to find good people, expensive, but police are hard to employ. So we've invested in a number of companies that help police forces police, quite frankly. So here you're talking about body cameras. You're talking about using tasers instead of weapons. You're talking about drone technology. One of these companies, these are all smaller cap ideas. They've been very good investments for us. But one of them just simply points out that why wouldn't you have a drone for every police car in the world in the future, quite frankly, to improve public safety. These are companies that are doing very interesting things around this area. It's clearly a growth area because every government in the world needs to invest in it. Otherwise, they're going to lose their job if their citizens are not safe. And we see that as a strong structural trend over the next 5 to 10 years, where there's a number of good ideas that we found over the last couple of years.
Yeah, fascinating. What about you, David?
Not so much a theme, but I guess a sector of the market where we're really optimistic going forward is just in healthcare. So Australia has some of the world's leading healthcare companies, be it Cochlear in developing cochlear implants, CSL in blood plasma products, ResMed in the treatment of sleep apnea, and Fisher & Paykel, which is a New Zealand company, but dual listed here, which is treating respiratory disease. So all four of those companies have enormous opportunities in front of them. They're all clear market leaders where they've got the dominant market share in their end markets. And so we can see a long runway of growth for all of them for many, many years to come.
And what about you, Tim?
A slightly less sexy space, but one that's been performing really well and we continue to see a good dynamic for is gold. Inversely correlated to the US dollar to the extent of 85%, has been performing strongly as suggested, and also a beneficiary of geopolitical risk. Fortunately, in the small cap space, one of the benefits is just the sheer number of companies that we can look for, and we've got 5 times the number of gold exposures as the ASX 100. The other one that I might quickly mention is just an industry that's been in structural sunset decline now for 2 decades, and that's old media. And you can see it live with the younger demographic. They just don't watch it unless it's sports content. And even I think next year in the AFL for the first time, for the first portion of the industry, portion of the season, there won't be Saturday night televised games. In contrast to that, the spending on sports content is just ballooning. If you look at the revenue CAGR over a 30-year period for English Premier League, it's up 15%. There is a company that we believe should benefit from that. It's called Catapult Sports. It's a sports technology born out of the Australian Institute of Sport. It has had a few hiccups through time. But with all of that money rushing into that sport, there's just a proliferation of sporting teams.
I'm going to flip the question on its head. Paul's the glass half full, I'm the glass half empty guy in the office. Areas to avoid. Nick, I know you're a bottom-up stock picker, but at a sector level, are there places of the market that you just think should be avoided?
Other than China.
Since it was mentioned, old media.
Love this. Here we go. The boxing gloves are on now.
No, we are on our way to, unfortunately, Netflix through network effects, etc. You're going to end up with just a couple of big streaming platforms in the world. It'll take a long time, but that's where you're going to get in the long run. The other one I just point to is just fashion and retail is very hard at the moment. People, coming back to your point about the younger consumer, they're so transient these days. We've definitely had some mistakes in fashion over the years, and we've definitely made some money short selling some fashions over the years, but it's just fashion's generally a very hard area to get right for a long period of time. And you can see that with companies like Nike this year have misstepped, Lulu that's misstepped. It's just an area we generally avoid.
David, in an large cap Australian context?
Yeah, only for me, with just a repeat on the banks. So nothing structural in relation to the banks. It's still a very strong market structure. We just feel where valuations are currently, that there's better opportunities in the market.
Tim?
Well, old media was mine, but just sitting up here thinking aloud. Another one which is slightly contentious is online retail. And I'm not saying that online retail is going away, but there's very few pure online retail businesses that do it well. And the reason for that is they're essentially rent seekers for Google and Meta because the cost of acquiring customers is so great. And those two organisations can continue to extract extraordinary pricing for the cost of acquiring those customers. So we are increasingly seeing some of those pure online retailers adopting an omni strategy, which is incorporating shopfronts.
Okay, now I can see we've still got everybody's attention, but this is the bit that you want to listen to, right? And I'm going to start by saying James told you that this is not advice specific to you. This is general in nature. But last year when we asked Nick, what stock must you own for the next 12 months? He said NVIDIA. Very impressive. So these gents here are under no pressure, are they? Okay, so our favourite question before we get James back up to have the audience ask questions. So please be ready. It's a great opportunity to ask questions. But if you had one high conviction idea that you could invest in right now, what would that be? And
Not NVIDIA. Can't say it again.
I can't say it again. How many people bought NVIDIA when I said last year, just out of interest? Thank you. Okay, so not enough of you did, so I'm going to say it again. I'm sorry. This company, in our opinion, will become the biggest company in the world by a very, very large margin, okay? NVIDIA is the hardware and software platform for AI, and I was literally in their office 2 weeks ago. The lead that they have over their peers is so big that I don't see anyone catching them. And the best way to think about NVIDIA from here is when the iPhone came along. Okay, so the iPhone came along, one of these. Everyone's got one. Do you remember when you didn't have one? Okay, so Apple is the hardware and software platform for the mobile internet, okay? You can go to a Telstra shop today and buy any mobile phone you want, and they all have exactly the same technological specifications of the iPhone, but you all buy the iPhone, or most of us do. Why? Because we're trapped in the hardware and software ecosystem of Apple, okay? If you want to build AI, you are effectively trapped in the hardware and software ecosystem of NVIDIA. So NVIDIA, if you think AI is going to be big, doesn't have to be this year, over the next decade, then NVIDIA naturally will become the largest company on the planet. If you do not want to own NVIDIA and you just want to own something else, then you own the NVIDIA supply chain. And then I would just point to a company like TSMC as the foundry that makes NVIDIA chips, or ASML that makes the tools that help TSMC make the chips for NVIDIA. Those are the three that we'd point to. But I did NVIDIA again just because only one person in the whole room bought it.
Nick, just with the big tech stocks, are there, just kicking the thesis apart, are there political risks with these stocks that these companies just get too big and legislators get involved and want to break them up? And
So that's definitely a risk for the platforms. So Google is obviously getting a ruling tonight, which may try and break certain parts off Google, and it's definitely a risk for the platforms. But semiconductors are the new oil, okay? We are going to protect Taiwan like we used to try and protect Saudi Arabia. Like, that's what's going to happen here. And so the companies that are at the leading edge of semiconductors, which is NVIDIA, and the foundries in Taiwan, and the tool makers in ASML, which is Dutch, these companies, in our opinion, are the enablers of all this compute. And so they become these incredibly important companies on the planet that will make them politically quite footballs. But ultimately, all that's telling you is how important they actually are in what human progress needs to do over the next decade if we're going to solve a whole bunch of the world's problems.
Now, before I ask you, David, I'm just for the advisors' mental health. Can we not have 200 clients please email this afternoon saying they want to buy a video?
That was not stock advice. That is only our view. And if you own our fund, you can be comfortable in the fact that NVIDIA is the largest position.
And that's an outstanding finish to that question. Nick, that's exactly, you've got the Munro Fund, okay? David, if we had to say to you, righto, what's a company that you think would be a terrific investment for our clients, a domestic stock in the upcoming period? Let's say with a 3 to a 5 year view, what would you point to?
Yeah, so for me that would be CSL. So this is a company...
Here we go. This is a setup. This is a...
I promise...
This is a setup. They've colluded, these two.
I promise this was not a setup.
This is a setup.
which is also a large holding in our portfolio. So CSL has a really long track record of deploying capital and getting a higher return for shareholders. So the return on capital had grown quite steadily for a long period of time, and you saw the share price follow that. As we said, in the long term, share prices follow earnings. In the last 5 years, there's been a couple of missteps from the company. One they could control, one they couldn't. And the one they could control was the acquisition of Vifor, which they bought a few years ago now. That hasn't quite come through to the same extent as what management had thought. Now it's only a small part of the earnings, and we think that the share price reflects the weakness in that business than what was originally intended. So we think that's already priced in. And the second one was just the impact of COVID to the business. This is what they couldn't control. So we saw during COVID there was a lack of mobility. Blood donors were unable to get into the collection centres to be able to donate. And what that meant was there was a shortage of supply for CSL, and to try to stimulate the demand, they had to increase prices and incentives for people to come in. That saw their margins get hit pretty steadily, and so margins pre-COVID were about 59%. That fell to 52% at the lows of COVID. And we're now starting to see that return. So demand is holding up really well, supply is now returning, and the costs are coming down. So we expect to see multi-years of double-digit earnings growth for CSL. And I think the other point is, during that period, they weren't sitting on their hands. They invested the free cash flow that they do generate into their own operating equipment, and they're now operating more efficiently than what they have previously. So we think that you're going to see really strong earnings growth coming through, and that's all at a valuation which is below its long-term average in terms of multiples. And you know, this company still invests over $1 billion in R&D, coming up with the new technologies and new therapies to continue that earnings growth.
Just better than good, David. And lastly, Tim, everybody loves an ASX small company tip.
Well, Nick set the standard pretty high when his selection was going to be the world's biggest company. I don't have that privilege. The company that I'm going to give an example of really demonstrates the small, nimble elements and attributes that you can find in the small cap end of the market. And this is a telecommunications company, so it's not especially racy, but it is certainly benefiting from everyone's data consumption. And it is certainly benefiting from Telstra. It's a company called Superloop. Superloop, the ticker's SLC, once again, not advice. But this is a company that we watched for 9 years, and we watched various missteps, bad acquisitions, regionalisation up into Asia. And what got us excited really was a management reset of the strategy, where they really just brought it back to first principles and focused on the Australian market. This is a company that over the last 6 years has trebled its revenues and increased its earnings tenfold. And in contrast, Telstra's revenues have declined and its earnings are up a bit. This is a company that continues to take market share on NBN internet reselling, but also has activities in wholesale and enterprise. So if you can think of it, that essentially all the telcos now resell NBN, so it comes down to your cost structure above and beyond that. And they haven't had the legacy issues that Telstra have. So they have a fairly automated process and a much greater or lower cost structure. One of the other catalysts that has really come about recently for Superloop is that they've white-labelled their product to Origin Energy. And so not only if you're an Origin Energy customer that's getting electricity provision, you can also now get internet provision. And their subscriber base at the moment is 150,000 broadband users, and their aspiration is to quadruple that over the next few years. So we still see some pretty attractive upside in Superloop.
Great, thanks guys. So I'll ask James to come back up, but I think everybody would agree the quality of the responses to the questions Patrick and I have asked, you can see why we have so much confidence investing in these guys through their strategies. So yeah, please take the opportunity to ask questions.
Okay, just one more round of applause, please. It's a fantastic session. Thank you, Nick, David and Tim. Thank you very much. All right, so we've got a couple of roving mics, and we've got Witty on this side here and May on this side. I'll try and go from side to side. I'm sure there's going to be a few questions. So thank you, Witty and May. Can we start the boat? Just the front here, May. Thank you.
Do you mind if I don't stand up? My name is Trish Faby. Thank you for a most interesting session. It's fantastic. I'm going to throw the ball at you, India. I've got a lot of clients from India. One exports Australian wine to India. I was shocked. What are you seeing with all the negotiations that's going on with our government in India, plus the changes in the government in India, which has been quite intriguing? Do you see that as a future market, particularly as we don't have China?
So great question, and the short answer is yes. We do not have any investments in India today. The only thing that holds us back in India is I agree with China out of the picture, and India is going to do well, and we did put a bit of money there for a while, but then ultimately we needed that money for some of this other stuff we were looking at. NVIDIA, shush. Yes, I won't mention it again, I promise. But I completely agree with you. There's a number of things I like about India. One, it's colonised by the British. Anything colonised by the British generally works. Things that aren't generally don't, in my personal opinion. And the government is very pro-business. You also have a number of companies that are founder-led and with some very charismatic founders who've built great businesses. There's only one thing that holds India back, is none of this is a secret. Everybody has known this for a while, and the Indian market is incredibly expensive. So you won't find many stocks in India that trade at a PE multiple of less than 50. And because the rest of the emerging markets are so bad, and they are generally not great, if you're an emerging manager, fund manager, just all your money ends up going in NVIDIA. So it ends up being, into India. So it ends up being, got me, all your money ends up going into India. So it ends up being quite expensive. The one company we have owned there that we like quite a lot is a company called HDFC Bank, which is it's essentially the Commonwealth Bank of India. And it's incredibly well run. But everything about it I like, except the price. And that normally tells you should buy it anyway. So we should probably, hopefully this time next year, have a few more investments in India.
Can I ask our two domestic managers, are you seeing India as a greater trading partner to Australia, or the vice versa? Is there any trend in that area?
Yeah, I can just talk from a commodities perspective. So there is an opportunity for coal to be sold into India. So India is not self-sufficient on coal, so we expect that to go through. And we are seeing both BHP and Rio, or BHP, displacing coal volumes into India. In an iron ore perspective, though, India is largely self-sufficient and will be to the end of this decade. So there isn't a large opportunity for the next 5 or 6 years at least in terms of iron ore demand, given that self-sufficiency.
Beyond commodities, not a huge degree of exposure in the ASX small cap end of the market. One company that did tremendously well for us for a number of years before it entered the ASX 100 was IDP Education, that specialises in English teaching and testing, as well as international student placement. But with a cut down recently in various immigration laws, that's had a few more headwinds emerge in that company.
Okay, any more questions? Thank you, May.
Gary Egan's my name. Question for Nick. It's about the clean energy area of interest. I've been following your podcast with GE Verona and Constellation, and I'm wondering about your thoughts on other energy generators, and particularly hydrogen.
So, yeah, as in hydrogen as a fuel source, correct. So, well, firstly, thank you for following the podcast, and I'll give it a plug. If we don't try to keep this stuff to ourselves. So Constellation and GE Vernova have been two of our better performers in the last year, and as you know, the climate funds had a very big last 12 months. What is driving that is really this shortage of power that was already there because of the shift to decarbonisation, and it just got accelerated because of AI. In terms of other power sources out there, so your specific question, Constellation's been so successful, and for those of you who don't know, Constellation owns 16 nuclear plants in the United States. These are existing nuclear power plants. And it's been so successful because there's just not a lot of existing carbon-free baseload power in the world. And so it's quite a unique investment. It's a bit of, I call it like an energy unicorn. From here, everything else apart from what Constellation has is maybe a couple of other nukes around the US. There's existing nuclear generators in places like Finland and the Czech Republic that we've also invested in, and Japan also, where we haven't invested. But everything else you're going to have to build, right? And everything else you build is going to be competed away with returns to a certain extent. And so what do we think they'll build from here? I'm not saying they won't, but if they do build, the fastest time to market is gas-fired power. And so that's why we own GE Vernova, because it's the largest supplier of gas-fired turbines in the world. That'll be the stuff that comes to market quickest. Wind and solar, you can only build so quick. Wind has definitely got some problems at the moment because offshore doesn't work, quite frankly, and onshore has site problems. Solar has site problems. So then you're down to hydrogen. Hydrogen is very long-tailed at the moment. Most of the hydrogen we're seeing at the moment is sort of blue hydrogen, if you know what I mean by that, which is essentially refineries lowering their carbon footprint or petrochemical plants lowering their carbon footprint. But hydrogen powering, green hydrogen powering stuff, and we're getting a bit complicated here, long into the future is well beyond 2030. I'll probably stop there, but happy to just corner me afterwards if you want to talk more about it, if that's okay.
So we've got one at the front here, Widdy, thank you.
My name is Bogdan Skomra. I've got a question. Do you take in your investment decisions possibility of China invading Taiwan?
So yeah, it's a great question, thank you. It's a question I get asked pretty much at every presentation in the last 5 years. And the answer is I don't know if China is going to invade Taiwan. I just don't. I personally think it's a very low probability because what's happening now is this is becoming a much more prevalent issue. And the reason why it's becoming a prevalent issue is because everyone's saying, do not do that. There would be no technological benefit for China invading Taiwan. So if China invaded Taiwan, they don't get access to the semiconductors because all you do is you just turn off the servicing of the machines and then they don't get access to it. They don't get access to new machines, so there's no technical reason for them to do it. They would only do it because they believe in the reunification of China, and that they obviously do believe in, which means you can never discount the risk. My point would be, this is why we own put options on the market, for instance. So this is why we own put options around Israel and the Middle East right now, because I don't know what's going to happen, so why don't I just spend a little bit on some insurance? That's the same way we would treat Taiwan. If China did invade Taiwan, my TSMC investment would be the last thing you'd be worried about because you're basically in a global depression. Because it's important that everyone realises that if you haven't read Chip Wars, you should read Chip Wars. But every single device on the planet is driven by a semiconductor that is made in Taiwan. So every aeroplane, every car, every phone is driven by a semiconductor, a high-end semiconductor that is made in Taiwan. So you will end up in a very large global depression, which is why I don't think it will happen, but I obviously can't discount it.
Okay, maybe you got someone down there? Just over there, thank you. That's it? Hand up. Thank you.
G'day, Hutch Hutchinson. I'll just follow on from the last question. I guess that was a war that hasn't happened, but we've got two wars going at the moment, right? We've got Russia, one of the world's largest suppliers of all sorts of commodities, and we've got Israel. And Israeli companies pervade the world. Israeli investors pervade the world. So I'm just wondering, what do you see the effect of those two ongoing conflicts and in investing in businesses associated with them, but also the potential for an oil shock? with Iran in particular?
I reckon that the oil one's very interesting, guys.
Yeah, I think absolutely the potential for an oil shock. So we obviously don't invest into Israeli companies per se, but yeah, absolutely an oil shock is something that we're mindful of, and probably surprising to us that the oil price has been pretty steady despite an escalation of the conflict in the Middle East. And so it's something that we're watching closely, but I think anything to do with energy, how stable it's been just over the last 4 to 5 weeks surprises us significantly.
Anything to add to that, Tim, or is that...
I think it sums it up.
Look, I'll maybe make one point is obviously as investors, we can have views on these things, but our job is to find earnings growth. And so there we're effectively trying to follow the money. There's obviously the risk is that on the commodity side, this creates inflation. And we obviously saw that when Russia first invaded Ukraine. It was definitely one of the big contributors to the inflation problem that we had. To put it the other way, though, the opportunity here is really around defence spending in Europe. Europe is massively underinvesting its NATO targets. If Donald Trump wins, he's not a big fan of NATO. And most countries in the world, defence was very much a dirty business to invest in for a very long period of time. It was a dirty word, and ESG made it worse. I think people now realise that defence is an important part of national stability, and it's something that money should definitely go to. And so we see a strong uptick in defence spending, and we have invested in a couple of defence companies for this very reason, because we think it's integral to a nation's safety, and it's an important part of keeping peace in the long run. And that's been a change of view that's happened, and that's the opportunity that we've seen out of this, at least, if there is one.
Okay, thank you. Good. Just at the front here. Thanks, Woody. Thank you.
My name is Astrid Werner. You haven't talked much about climate change. How does that influence your investment? Who are the losers, who are the winners with increasing climate?
It's a big question.
Can I do this one?
Yeah, go on.
So we actually launched a climate fund. It's the enablers of the gentleman referred to earlier, and I believe it's definitely used on the GFM platform. In that fund, we invest in what we think are the enablers of decarbonisation, because we believe decarbonisation is going to happen, and that every company in the world will set some sort of net zero target and attempt to try and get to it. And again, what we're saying here is this is an opportunity, because ultimately that's going to cost a lot of money to get to net zero, and so our job is to follow the money as to where they'll invest that money. That's how we ended up in things like GE Vernova and Constellation Energy, and we bought these companies years ago. And they've worked out well. So from my point of view, decarbonisation is basically just a part of the investment framework now for the next 30 years. Every company in the world has set these targets. Investors will hold them to account, and their job is to find a way to hit them. And in doing that, we also have our own ESG and responsible investment officers, and we hold them to account. So we have a conversation with Microsoft just this week, just going, hey, you've set this net zero target. How are you going to get there, guys? Like, how are you going to do it? Because you're building all these data centres, but you've got this net zero target, so what's the missing piece that we don't know about? And so our job is to hold them to account, to make sure they do it, and then obviously identify the investment trends that come out of it. That's sort of how we feel about it. And is it going to happen in 30 years' time? I don't know. I don't know whether we do decarbonise the planet, but I know that a lot of the biggest companies in the world are going to keep trying, and that creates the opportunity, and obviously particularly for our climate fund, and hopefully provides you with some comfort that something is actually being done about it.
Can I jump in and ask David and Tim, because I think this is fascinating. Australian companies, the corporates that you're dealing with, how seriously are they taking decarbonisation? And maybe if I could take it a step further, are you seeing companies that you don't think are serious about it, and what's the risk for them if they're not?
Sure. So typically what happens with these sorts of phenomenons or these sorts of trends is that there's a trickle-down effect. So they start at global, come into the large caps, and then find their way down into the Aussie small caps. So these days it has actually absolutely changed behaviours. Every conversation we have with management teams, there is a component that lends itself to ESG and climate change conversation. And some of these can be as easy as, or not as easy, but as simplistic as increased solar usage, like Beacon Lighting, for example. Lighting retailer. Nowadays, they're certainly rolling out all their stores with that capability. If you looked at the fund overall in terms of climate change. Over the last while, the fund has benefited from the government-induced EV transition. So there is a financial incentive for people to lease their cars through a novation and get a financial benefit through that. Transition minerals, so the panel's discussed a few, the electrification trend, and certainly lithium is featured in that, rare earths, uranium got a bit of airplay. But also, it can be as simple as just that whole electrification and the whole proliferation of solar panels in this country has added tremendous network complexity. And so with that, there's a trickle effect throughout the organisation. A lot of these utilities are having to spend millions and millions of dollars upgrading their software systems, their billing and their customer-facing systems. And so there's a company on the ASX, it's actually a New Zealand company called Gentrack, and they're a world leader in that space, and are certainly benefiting also from the fact that their largest competitor, SAP, is coming to a sunset end on their technology, and between SAP and Oracle, it's 80% of the market. So to answer your question, I hope I have, but it is permeating through, and I would say in the last 3 years, the change has been more dramatic than the prior 10.
And at the top end of the market, David?
Yeah, I think like we're encouraged, as long-term investors, this is one of the things we need to consider because it can affect a company's licence to operate. So we need them to be around and earning good cash flows and good earnings in 5 to 10 years' time. So we're really encouraged that we're seeing pretty much every company now take this far more seriously than what they have in the past. Where it's probably most pronounced for us would be in the LNG or oil and gas producers in Woodside and Santos. And again, they've got target action plans in place now. We're encouraged to see that they've set goals rather than targets specifically that they're trying to achieve. Now, in many instances, to be able to achieve these targets or goals, they need technology to improve from here. So the technology doesn't physically exist for them to be able to meet them any sooner than that 2050 target. But we like the fact that now we can monitor the company, you can see how they're progressing and that they maintain that licence to operate. And for that reason, we love to see the initiatives being put in place. And the last thing we'd want to do is see these companies sell these assets and put them into less responsible hands. So we want them in the hands of Australian listed companies under our jurisdiction. They're doing the right thing to try to reduce their carbon emissions.
Okay, thank you. So we're just after 10 to 2. We've got a couple more questions from the floor. Happy to take. Okay, thank you, May. And then the one after that as well too.
Hey guys, thanks for your insights and your optimism. Nick, I was going to take Sharon to buy a Toyota after this, but she might put pressure on me to get a Lexus. Maybe if you guys could help me, you guys are long-term thinkers, help me finish this sentence. By this time next year, I predict that.
Wow, Swans will win the flag. Melbourne will be premier. Yeah, we'll start. You, Tim, who's got an idea?
I don't know where to go with that one. I'd certainly like an interest rate reduction between now and then.
David?
CSL will be higher.
That's an even better one.
Nick? Let me guess, this is going to involve...
Yeah, look, we hate jinxing ourselves, particularly on one-year time horizons, but I'd be reasonably confident the market's higher this time next year.
Good question, Tim.
Good question. Okay, one here. One more, I think that will be it. I think we've got one more further down there. Someone else put their hand up just down there? Okay, so we'll do this one, then one more.
My name's Rhett Kirkwood. I have a question for David. David, I noticed on the AFIC chart that you had Woolworths and Coles as stalwarts. Is that going to remain the case?
For what we can see this stage, yes. So great industry structure. You've got an oligopoly, both generate reasonable earnings growth, both generate material free cash flow. So we like that industry structure and the ability for them to be able to continue to grow earnings. We're watching the ACCC inquiry as closely as we can. At this stage, it doesn't look like it's going to be a material impact to the way that they operate their business. But it's early days on that, so we'll just see how that progresses over the course of the next little while.
And I think we had one next to Adam there, I think, yes. And then one at the back, and that'll do it for the day, thank you. Yeah, just next to Adam. Thank you. Sorry, I can't see.
My question is, if you're an investor where income generation is an important priority as part of your portfolio, what would you recommend you should have in your portfolio for the next 12 months?
I think we'll focus domestically for this question, if we're okay with that, Nick. David and Tim?
Yeah, so in terms of our income objective, which is one of the two that I mentioned, so we still are getting reasonable income out of the banks, even though I said that they're overpriced, so I've reduced our weight quite materially. But it's getting harder for income growth across the ASX just in the next little while. So the expectation is that the iron ore price will drop from where it has been over the last 5 years, as I mentioned, and that the banks are going to deliver very minimal earnings growth. So you look at those two sectors and the percentage they represent of the Australian market, it is getting much harder to be able to get income growth. I think one area where we're starting to see it being better is in the REITs, where it feels like they're through the worst in terms of the challenges they faced operationally. So we expect to see reasonable earnings growth from the REITs over the next little while, but you need to be selective in that regard.
REITs being real estate investment trusts.
What about you, Tim?
Small caps aren't renowned as dividend payers or certainly high dividend yielding stocks. Typically, through my journey, those companies can be a flag for earnings disappointment to come, which means that the numerator, the price has fallen, and yet people haven't moved their dividend per share. Typically at Fairview, we really appreciate those companies that have high return on invested capital and therefore can relay the cash flow that they generate back into their businesses to continue to power the earnings profile.
And Nick, I'll maybe just get you to jump in. I think by global standards, I think global companies look at Australian companies and wonder why they pay out so much of, or many companies pay out so much of their profitability. We don't see this internationally, do we?
No, but it's because of the tax system. So franking credits is honestly one of the greatest gifts the world's ever created, and we're very lucky in Australia to have it. And so by definitions, if you want income, you should definitely focus on Australian stocks because the rest of the world can't give you the franking credits. And so that's a gift, particularly in retirement, that you should definitely take advantage of.
Okay, and our last question for the day. Thank you, May.
Thank you. My name's Rob, surname Brisbane Lions.
Thank you, Rob.
One of the first things I wrote down on my pad after Nick started to talk was AI. I wasn't going to ask the question, but he brought up the word also, the words with the climate change about the missing piece. Now, if I use the pyramid, so I go back one step, AI is fairly new. If you use the pyramid, we're at the top of the pyramid with our money. Under that is Gillams, going down the pyramid, looking after our money, advising. Then we've got you guys as our guests today, further advice. And then you mentioned companies like NVIDIA. There seems to be a bit of reliance on AI. How do you know there's no missing piece within AI, seeing it's fairly new in my mind anyway?
Yeah, okay, so it's a great question. So we would identify AI as one of the themes we're invested in. Probably makes up 20% of the portfolio today. But if you add the power ideas on top of that, it would be bigger than that. I also talked about public safety and, we also invest in healthcare, etc. So this is one of our bets, but it's definitely the exciting bet that drove the fund over the last 12 months. And I think it will continue to drive the bet fund over the next few years, is what I said. What's the big risk? Okay, so what's the big thing that we don't know? We don't know how much everybody in this room is going to use these products. So the products are coming, and the products will be very good. How many people are ChatGPT users, just out of interest? Okay, so that's a few more than last year. How many people are paid subscribers? Yep, a few. And I suspect by this time next year we'll have more of that, if that makes sense. And so the big risk when you invest in one of these technologies is not that it doesn't end up being great. It does end up being great. You just pull forward all the demand. And we saw this in the dot-com boom in the late 90s, where we pulled forward all the demand for the internet. The internet ended up being great, but we had to pop the bubble first before the internet actually ended up being what it has been. Could that happen again with AI? Yes, it definitely can. There's a lot of investment happening right now. you could be pulling forward a whole bunch of demand that Luddites like us that can't actually work out how to use this stuff at the speed that it's actually built. My point I was trying to make there was you're only 18 months into this, so it'd be very unlikely that you'd pulled forward the bubble to today. The bubble may appear, but it probably appears down the track, if that makes sense. The overinvestment would have to go on for a number of years before that would happen. That would be the main risk. And so the big question I would ask you, the investor, to think about, and what we think about a lot, is the best ideas are always the ones you end up using. The best ideas are always the ones you end up seeing. So we own a lot of shares in On Running, okay? Anyone seen On Running shoes? I talked about that last year as well. Every time I see a pair of On Running shoes, I'm like, geez, I'm glad I own that stock. And so I would treat AI the same way. If you find yourself using the product, seeing the product, and seeing the magic of the product, then you're on the right track. That's how I felt the first time I got an iPhone. It's how I felt the first time I Shazammed a song. It's how the first time the iPhone, whatever. And so put simply, I suspect you'll end up using this product a lot more than you think over a very long period of time, which is why I think you're closer to the start, but that is clearly the risk.
And Rob, despite barracking for Brisbane, you asked a very good question. And the view that the role that GFM plays in this is you never have all your eggs in the one basket. I think we all know that. And just a simple analogy, if you equally weighted across the three portfolios Nick, David and Tim run on your behalf, you would only have a 7% exposure to AI. Okay, so while it's a big investment theme and it's a big topic, we would never allow you to be invested in such a way as where you had all your eggs in the one basket. But do we love the fact that Nick brings that to the table for you with the part of the portfolio that we invest on your behalf in Munro? Absolutely, but it's our role to make sure that you're diversified.
Okay, so it's right on 2 o'clock, so we'll finish up for the day. I just want to thank Paul and Patrick for hosting today. Well done, guys. Great job. And also to... once more for Tim, David and Nick, thanks very much for supporting us, guys, and coming along. Thank you. All right, enjoy the rest of your day and the week, and we hope to see you all very soon. All the best. Bye.